Yeah. Good morning, everyone. This is Rashmikumar Shah here from Texas, US. Uh, on behalf of Simplicity, I'm doing this webinar. Uh, like every time, I just want to have some of the caveats that this webinar is for people living in India and not for US investors. And as we all know, we are promoting this service only for Indian investors living in India. Okay, with this, I just start today's webinar. Yeah, so thank you. Good morning, everyone, for joining at 11 a.m. On Saturday morning, sharp. I'm doing this webinar after almost a month and a week. Thanks for the wait. Yeah, we are living in a very interesting times, correct? As the entire world is going through the COVID crisis. In every country is in a different phase. India went through a terrible second wave, and it's still not gone through that wave completely, but the peak we have already achieved, and we have seen, and now we are recovering, correct? So, but the market has gone to all-time, stock market has gone on to all-time high, and so where do we go from here? What do we do, correct? So investors are asking questions, clients are asking questions. What do we see from current level for next 2-3 years? What's going to happen, correct? So what we need to do, if the markets are at all-time high, Indian markets and also the global market, what is the one thing we need to do? The one thing we need to do is, all of us is, change our mindset. Because in COVID has shaken up every country, every company, every business, every family in the world. And it's making us look at our life, our business from scratch and relook at it and change, correct? So same thing goes with our investments. We need to relook at our finances and with a different mindset. Why different mindset? Because the world is not going to be going back to what it was in pre-COVID, and the world has changed. And the world has changed, okay. COVID was a terrible thing to happen. A lot of families got affected. We all got affected. And everyone in every family, we have seen some sad things happening. Yeah, but on the side of that, the COVID has brought a new thing also, correct? It has changed the world, and it has made us to innovate and do some things in a different way. And because of that, the world with post-COVID is going to be a very different world, and it's going to be a good thing. So that's why the markets are going up. Markets like change. Market doesn't like, financial markets I'm talking about, doesn't like stagnation. So with everyone, every company, every business changing, markets is going up, and it's looking at the future in a bright way. And if we remain pessimistic, then we'll miss that bus. So we need to change our mindset to look at the market, correct? So India is going to benefit, correct? So now, if we don't change our mindset, there are two kinds of mindsets, correct? A mindset with the growth, and the mindset, fixed mindset, rigid mindset, correct? Now, we are in the business of advising people on money, but 85% business decisions and monetary decisions are done by people by emotions. We are very emotional people. So we need to understand the emotions of the people, and they take emotional decisions on money. Now, when we deal with the people every day, and what we have noticed that there are some people who are with a growth mindset and people with a very fixed mindset. So what is the big difference? The people with growth mindset, they can see the big picture. When we explain them, look at the big picture of your life, look at the big picture of your family, look at the big picture of your assets, They understand what we are talking about. They are very optimistic people. They think optimistically. They can read between the lines. So if any news is circulating, they can understand why this news is circulating, what it means and all that, correct? They are people with growth mindset. They are very open. They admit their mistakes, what they made in past, and they are not ashamed of it, and they like to correct those mistakes. And they like to follow up. Once you work with them, and we said them, this is a process we are going to work, once they agree on it, they sign on it, they follow it. They don't keep on changing, correct? And they are delegating. They delegate the decision making. They trust, correct? And they work in partnership with us. And those are the people they take the maximum benefit of what's happening. Whereas people with a fixed mindset, they go after every transaction. Every transaction they want to time the market. Everywhere they want a deal. Everything they suspect that something bad is going to happen. Every news on WhatsApp which circulated, they get influenced by that. It's very easy these days to submit any sensational items, create a story and submit on WhatsApp, forward it on WhatsApp and social media, and people start believing it, correct? They never admit their mistakes. They always hide their mistakes. They always think that everyone else is wrong, they are right. And they're not ready to learn, and they always micromanage. So if those is the mindset, it's very difficult to take advantage and be positive, correct? So if you really want to benefit what's going to happen in the world in the next 5 years and 10 years, please change your mindset. Please relook at all this. Look at the big picture, and then that will help you. So this is the first thing what you need to do, correct? Now why I'm saying this, because in my next slides I'll share that with you. As I said, 85% people are emotional investors. And do you know that? And they are, so I'll give you an example. In US these days, I have the data for US, I don't have the data for India, but in India also it must be the same thing. What is the average period one person invests in US stocks? 10 minutes. So every 10 minutes, the stock in US changes hands, and they call that investing. That's not investing. That's trading, correct? Now, investing means you buy certain things and you hold it for 5 years, 10 years. That's called investing. And that kind of population is less than 10% in the US. 90% are traders. Same thing in India. So somebody buys a very good script, Nestle or Hindustan Lever. It is not moving for the last 6 months. I'll sell it. And they want to buy something which is moving. So what has happened because of that? That's a trading mentality, correct? And when you do that, you miss the golden. So in financial market, in stock market, people with patience make the most, correct? People with the patience make the most. So you require, and you have to follow a process. That kind of people population is very less. So out of 10 clients, we get one person only is on that, looking for long term. And those are the only people who create wealth. Remember, historically, anywhere in the world, only 1% of the population creates wealth. 99% people dabble with the stock market, earn some money here and there, but they really don't create wealth. So if you want to be in that 1%, think about long term and think about investing. Now, coming back to COVID again, how COVID has impacted every family, every individual in the world, correct? COVID has, on the health front, every family has been impacted. Every individual has changed. So there is going to be massive of post-COVID investments in the healthcare infrastructure. So healthcare sector as a sector is going to be a slow compounding sector where growth is going to be there, and good companies are going to give it compounding means they are going to give a returns which will compound wealth, correct? So long term. So long term it's a growth story, and they will keep going up steadily. Yeah, not the way at the speed at which they went up last year, In last year, after March till today, healthcare has given almost 95% return. You won't see that kind of 95% return in 1 year, but you will see 15 to 20% return, correct? Steady compounding year after year, and which is a very good return that you will see in healthcare. Businesses, what we have seen in businesses, small and individual and organized business has got impacted everywhere in the world, whereas corporates have benefited. So India's GDP went up only by 2% in last 1 year, but the corporate profits of top 200 companies has gone up by 40%. That's why the stock market has gone up. Same thing has happened in US. The top 500 companies in US has benefited tremendously, whereas the small businesses have closed down. And that is the pain everywhere, in every part of the world that has happened. And that trend is going to continue. As far as the finances are concerned, people in developing countries like in India, poor people have become more poor. In India, many Asian countries, in Africa, South America. But in countries like America, poor people got $10,000 check from Uncle Sam. And plus, if they lost their job, they earned 125% of the salary for 6 to 8 months. Uncle Sam paid them. So they became richer by not working, and they got a lot of cash. So, and their savings have gone up. So poor people in developed countries, their cash flow has improved before COVID after COVID, correct? What was before COVID and now. And that has happened. And in education sector, for long-term impact of COVID is going to be there. Every education institute will have to rethink about how to, especially colleges and universities, upper end. The world has changed forever for them, and that is a sector which is going to see a most pain for next 5 years. Education sector, and this is that has happened. Correct. Now coming back to COVID, so world is getting now ready to live with the COVID. We are in a stage where world is looking at very optimistically. In India, the COVID cases have peaked. 14% of population is already vaccinated by at least one shot as of today. 14% of India's 135 crores population. So that's almost 20 crores population, which is 2/3 of America's population. So, which is a big number. So it's as big number as number of people getting vaccinated in America totally. So in US, UK and Canada, more than 50% people have been vaccinated. COVID cases at its lowest. In America, Texas, everything is opened up. There's no mask mandate. Economy has boomed much more bigger way than pre-COVID. In last week was a Memorial Day weekend, 4 days. Per day, US people spent $1.25 billion on petrol per day. 1.25 billion, correct? Only on petrol. So that kind of rebound is there. China, Japan also have really opened up. Next week you are going to see Summer Olympics starts. International travel is still restricted, but it's slowly getting revamped. Domestic travel is completely opened up in the US. And other countries also the same thing is going to happen. The airline sector is getting ready to open up, and it's going to open with a bang. And international travel will start in a month's time, and we'll see back to normal in 2 months' time everywhere. So this is the state. So economy is on the set of rebounding, correct, everywhere. Now, the other thing, good news about is post-COVID market has surprised every person on the world. If 1 year back you would have asked me, Mr. Shah, do you think market will go up 100%? I would have, in wildest dream, I wouldn't have even predicted. Yes, I predicted that the markets are going to bounce back sharply, but I never I thought of that it was going to bounce back 100% in 1 year. No way. I would, but it bounced back very sharply. It surprised everyone in the world. Now, from here also, markets are going to go up, but they're going to go up at a gradual pace. But I'm still very optimistic. Uh, Now, Bitcoin and gold corrected in last 2 weeks. Gold is not moving up, but Bitcoin corrected sharply from $60,000 to $40,000. Why? Because the real economy is booming. When real economy was not doing well, the excess liquidity and the liquidity in the financial market was going to Bitcoins and speculation was going on. Now, as the real economy is doing well, people are selling Bitcoins and putting the money in the real economy, and that's why Bitcoin corrected. On CNBC, they'll tell you Bitcoin corrected because of a tweet from Tesla CEO Elon Musk. No, it's not because of that tweet. It's because of that money is coming back, correct? Now, globally, stock markets are at all-time high. Indian stock market also at a high. Now, let me tell you about Indian stock market. Indian stock market is influenced two-thirds by the movement in what happens globally and one-third of what happens locally. Always remember that Indian stock market doesn't go up and go down because what's happening in India. That's only one-third of that. Two-thirds is happening because of the global. So if there is a global liquidity and boom, India will also boom, irrespective of what's happening in India. And if there is a global meltdown, India will also melt down, correct? And now what happens is, if Indian economy is doing well in global liquidity, it will do better than the US markets. And if Indian economy is doing bad, in the bad times, it will fall faster than the US. Now, going forward, I expect Indian economy to grow in double digit next 1 year. They say Indian economy is going to be the fastest growing economy. So I expect Indian stocks to outperform NASDAQ and US stocks. Not next 1 year, for I expected them to outperform for next 10 years, and I'll share my reasons why down the line. So there is a disruption in supply chains worldwide. COVID has changed long term of every government, and technology has increased globalization, whereas in manufacturing sectors there is a deglobalization. So these are the trends we are seeing in the world economy, correct? Now, let me tell you one thing. We are not going to go back to last year's level. Now, if you see the history of last three corrections, so the one major correction was in 2002 and 3, then next 2008 and 9, and 2020. So if you see 2003 correction, Dow was at 3,000, NASDAQ was 980, and Sensex was 3,154. Markets went up from there and corrected in 2009, but the bottom was at 12,000, 4 times higher than the previous bottom. Same thing in NASDAQ, marginally higher by 30-40%. Sensex was 2.5 times higher than the previous bottom. Then after 2020 corrections happened, you see market went down from 42,000 to 26,000, but it never came back to 8,000. Same thing about NASDAQ, corrected from 12,000 to 6,860. Now, what I'm trying to say is when the next correction happens, market will not come back. It will be much higher than 25,600, 900. It will be at least 100% or 150% higher. So if you see every time, this gap is more than 200%. So if you take 200% from here, it is 75,000. So what it means is, it says the market is going to go up for next couple of years and correct, and it might correct down back to 75,000. So it means this market is going to go up to 100,000 or I don't know what number, and from there it will correct. But it's not going to come back. So, and the corrections will come after 4-5 years, not next month, not after 2-3 months. So we are in long-term secular bull market. So you need to invest and you need to rebuild your portfolio. Now, why you need to build your portfolio? Because going forward, the times have changed, the economy is growing, and things are going to be very bright. Now, why I'm saying this? So let's say you're playing cards, and in your cards you get 4 aces. So the economy is playing cards, and the economy has got 4 aces. And when you get 4 aces while playing card, you know you're going to win that game. So what are those 4 aces in the economy today, correct? So let's say the 4 aces of the economy next 10 years are very good. The first ace is the technology. technology is gone to a different level of innovation, and that innovation is going to be disruptive and creative, and that's why markets are going to do very well. Second, demographic changes are favorable. So, for example, India's population, working age population, that is people between the age of 20 and 60, is 2 times or 3 times higher than the population of people below the age of 20 and above the age of 60. So every family has a double or triple income family. Like in my father's time, only one person used to earn money, and grandparents, kids, we all used to be dependent on father. So there used to be, and mother used to also work at home only. So it was a single income family. Nowadays, every husband and wife, young couple is working, parents are independent, they have enough. So there is a double income family. So in some cases there is a triple, correct? Even parents are. So demographic changes is very favorable, and that's why the third ace is realignment of the global economy. That's the third ace. And the fourth ace, the biggest ace, is there is so much liquidity, so much money floating everywhere in the world, because every central bank has printed money, and there's cash floating everywhere. So these are the 4 aces. And when you have 4 aces when you're playing a game, you shouldn't pack up. You are going to win that game, correct? So these are the 4 aces. So let's talk about each ace individually. Currently, if you are playing the game of wealth management or these things, remember you have 4 aces. So going forward, next 3-4 years, you're going to win if you play them properly. The first ace is, correct, today every business is driven by information technology. So what happens is business productivity goes up multiple times, correct? A small business is not able to invest in technology, but a large business invests in technology and productivity goes up. So I'll give you an example of our Simplicity wealth management business. We are in the wealth management business, and we are completely technology driven company. All our processes, everything is online. We connect with every client online. Everything is digital. We grew during those COVID times by 100%. Whereas small advisors, they panicked. They were in physical mode. They were not able to serve the clients. And we are not only able to serve the clients, we have entire process, right from communication to everything, end to end, we are digital. So every business which is digital and has invested in technology has done very well. In Simplicity, our biggest capital expense is going to be on information technology. So any business which invests in information technology is going to do well. So IT is going to be a very big sector going forward, where everybody needs to invest and stay invested. So that is the first ace, I said. Now second ace is demographic change. So this is the biggest ace where India is going to outperform the world. So if you see this graph, in the year 2000, you see this United States, correct? This is the total population of the middle class in the world, correct? This is the total population. If there's 100 people in the middle class, US contributed this many numbers, other countries this, India contributed this, correct? That's Japan, China here, and India's middle class was only this much. Then, now as you see, the contribution of India's middle class as of 2020 is this much. US is this much, correct? China has much bigger middle class than India, but going forward, you see the growth of India, correct? India is going to be on a growth trajectory for next 20 years, and this is the biggest ace India is holding. So India is going to be one of the growth engines of the world, and you need to stay invested in India's capital market, and you will benefit a lot. So especially those who are youngsters, they need to be 100% fully invested. Those who are above 50, 60, like people like me, I'm 60 years old. Yeah, I need to have a proper asset allocation, but at least my majority, 70 to 80% asset allocation should be in stock market, and only 20-30% should be in debt, because at my age I need more money to spend, correct? So But the younger population needs to be more aggressive, and India is going to do very well. So this is the second most important people. I want everyone to keep this graph or picture in the back of my mind, that India is going to be what China grew between 1990 to 2010, and America grew between 1950 and 1970. So every country goes through that phase. So what history tells us, India is a young country. The same thing I'm talking about, what I said in the previous time, that average age of population is 28. In America, the average age is more than 40. China for 36, 37. India represents 1/3 of the world's young population. So the growth of Indian people, Indian economy is going to much faster. And history tells us, so when America had this kind of favorable demographics, that time technology was not there. That time internet was not there. That time mobile phones were not there. It was in 1950 to 1970. India is the only country which is in that phase of growth when mobile technology is there. So the growth in India is going to be even much faster and much quicker than China or US grew in that phase. So please remember that. Next 20 years are very good for India. The other thing, as I said, the third A is correct. Global geopolitics. So if you see this world graph, correct, where business is free, so if you see green part, where it's very easy to start. The most freest countries, New Zealand, Australia. Then you see in the North America and parts of Europe, you can start a business, close a business. India is in this part where most business is not free. But Africa, South America, they come under this category. India and China are in the same category, correct? Where a lot of government restrictions are there for everything what you do, correct? But still India is going to with a lot of liberalization and reforms and opening up. And because of India's, China messed up big time in this COVID time, and their relations with 16 countries, including US and everywhere, it's spoiled. So India is going to benefit geopolitically very nicely. And there is going to be redrawing of supply chain, and manufacturing sectors are going to be biggest beneficiary in India, Mexico, US, and this is the third ace. And the fourth and the biggest ace is the global liquidity. In last 1 year, consumers around the world, everyone saved a lot of money because they were sitting at home, and the salary incomes were same, and those who had a jobs, correct? So see this financial crisis, how the liquidity went up. Even this time it happened. So after it went up, you saw this flag going up, correct? This part. So now also we'll see that gradual going up, correct? This much. So you're going to see this kind of growth after the rebounding. And there's so much cash everywhere in America, India. Every American family got $15,000. A father, a husband, wife, and 2 kids. They got almost $15,000 from Uncle Sam in last 1 year or this year. 15,000 is a big amount, correct? And if somebody had lost a job, they got 125% of the salary for 6 months. And what that person did, they saved the money, correct? So the liquidity has gone up. And so as economy opens up, the wild spirits, people are going to go and spend. And economy is going to rebound very sharply. So that's why the future is very good, correct? Sorry, I missed one slide. Yeah. So the new normal is shift towards localization from globalization, correct? In manufacturing, digital cash is the king. So everywhere things are changing, and businesses are becoming. This is not normal business cycle. This is a very good business cycle. The world economic order is getting reshaped, and India is going higher up than the order. So we are going to benefit, and you need to realign your investments accordingly. The momentum sector-wise is going to change, correct? So if you see some of the stocks in India like Tata Elxsi, Tata Steel, Tata Motors, they have all gone up 200, 300% in last 1 year. Some of them stocks have gone 400, 500%. Now, we may not get such kind of high growth, but you will still get 20, 30% growth, 40% growth from the current level. in manufacturing sectors, and in many other parts of the economy you'll get, which is a very good, correct? So you need to realign and this. So re-rating of stocks and sectors is happening world over. So last 1 year, those who know me and those who have worked with Simplicity, from day one we have been telling everyone to keep investing in the market, and those who invested, they benefited a lot. Those who were skeptical, wait and watch and we'll see and this and that, they lost the momentum. The same way I'm saying now, keep investing in the market. I see a very good future going forward. So what moves the stock prices, correct? So there are multiple things which move stock prices. So here I've listed about 8 of them. And demand, interest rates, US dollars, inflation, earnings report, macroeconomic data, market sentiment, and supply, correct? Most of these things today are in a favorable position. So demand is more than the supply. Interest rates are low. Market sentiment is very positive. US dollar is weakening and it's benefiting India, correct? Macroeconomic data is very good for India. India's balance sheet is very good. Inflation is low and earnings are market share is growing up, correct? Now going forward, inflation is going to go up. Interest rates are slightly going to go up. Dollar is likely to go up. So what do you do then in that case, correct? So in those cases, the different sectors go up, correct? During this phase of inflation and interest rates, the manufacturing sector does well, value stocks do very well. So you have to rebalance your portfolio accordingly, correct? So you have to understand why manufacturing sector is going to do well in next few years. India and China, US learned it a very hard way. China quietly captured the manufacturing sector in last 20 years. So when manufacturing shifted from factories in India, US, and China became the factory of the world, there was a lot of unemployment in India, US, and the government had to bail those people out. And now both these governments have realized that instead of bailing people out, why don't I bail businesses out? I give incentives to set up manufacturing plants in India. So what happens is, and in US, when you set up local manufacturing plants, you create jobs, you create economic activity, and your dependence on become China less, and your economy becomes much more secure. And they've learned, and that trend has changed, that correct? So you are seeing in India government giving a lot of incentives for setting up factories in India, big time incentives. Same thing is happening in US. So in next few years, you are going to see if manufacturing plants are getting set up in India and in US, that means capital good industries are going to do well, basic metal steel industries are going to do well. So the entire economy, manufacturing sector is going to create a lot of jobs. And this is the first time which has happened in the last 20 years where manufacturing sector is going to see a long-term boom. And that is a very good thing, correct? Very good thing, and there is a multiplier effect it has in the economy. Though manufacturing sector contributes only 20% of the India's economy, 25% of India's economy, and in US it contributes only 15%, but it contributes in a big way. Service, so that impact is going to be very good, correct? Shortage of goods is going to lead for inflation. There is a shortage of goods everywhere. Today in America, you don't get a car, you don't get a boat, even houses, new houses, homes, home prices have shot up. Everything has shot up, the prices. Same trend, property prices in India has not shot up, but other than property, you're going to see inflation everywhere. So that is a temporary, but that inflation brings the pricing power back to the manufacturing companies and they benefit. So companies with high debt, so for the first time companies with debts are going to benefit because their capacities are going to be utilized and they have advantage. So if today, if somebody wants to build a steel plant, it takes 10 years. So already all the steel plants which are there in India, they are going to benefit tremendously, correct? And those are leverage companies. So their stocks, the multiplier effect is going to be very good. So this has happened. Last 10 years, companies with debt were doing very bad. Now it's going to be reversed. So that's why the old economy stocks are going to do very well. And you need to rebalance your portfolio. And other than service sectors, like even government sector, government is going to get out of the PSU business. So you are going to see a change of thinking, correct? A lot of investors. So don't throw your strategies out of the window. Focus, correct? Build a strategy and stick to it. You will see very good rebounding of the Indian economy and your portfolio. So there is going to be inflation. There is going to be inflation. Inflation has its side effects. As interest rates goes up, bond market doesn't do well in the short term, and it affects stock prices. But overall, the stock prices are going to go up, and use that opportunity when minor corrections happens. Get in the market and rebuild your portfolio. Correct. Now, the other thing which I'll tell you, when inflation happens, the US large caps, they perform the best. Emerging markets, they are slightly underperforming. But this time, this is not the case going to happen. This happened in the past. This time, even emerging market is going to do very well, because the manufacturing base, emerging markets like India, South Africa, Brazil are going to benefit well because of the commodity booms. And that's a very good thing. You need to focus on that. The other thing which I have noticed, see, this is the sectors which do very well. If you see, most of the manufacturing sector do well when inflation is there, and service sectors, they underperform when inflation is there. But because of the COVID, even sectors like healthcare are going to do well this time, because there is going to be more allocation. So many times what happened in the past may not happen again. There is going to be different realignment this time. Focus and build the. So simplicity is in the business of creating, helping people's wealth, correct? So I was analyzing all my clients' data. So what I noticed, that clients with having SIPs, they get 1.5 to 2% higher returns over a period of 5 years per year if they are investing in by SIP and no emotions. Now, what we have noticed at Simplicity, that for every 1 rupee of SIP, we get 2 rupees lump sum. So whatever we are managing, roughly about 300 crores today, out of that 300 crores, 100 crores have come through SIPs, 200 crores have come through lump sums. Now, the returns on that 100 crore of SIP is 1.5 to 2% higher than the lump sum. That's the trend. And mind well, this data is of lot of clients, and this is the true data, correct? So over a period of last 7 years, so this same trend is going to continue. So if you invest through systematic investment plans and let your emotions be out of the window, you do better shape. Now, the reason I'm showing this, so this is the economy in the market going up, correct? Different phases we are. So in the cyclicals, technology, sectors-wise, there is a sector-wise rotation that happens, correct? So you need to be there in the most of the major sectors, but all the sectors don't move at a one way. They move in rotations, and that's what's going to happen, correct? In the different phase, what happens is, so currently, last year we are saying pharma and technology were going to do very well. As you remember, in my April 2020 webinar, I said focus on that. This year I'm saying the manufacturing sector is going to outperform the other sectors. So infrastructure sector is going to outperform. So there is a rotation which happens, correct? So that the sector rotation is happening, but that doesn't mean that you get out of IT and pharma and all, but you give little bit higher allocation, correct? So that's to infrastructure sector, and that's what we are doing. That rotation is happening. Now, if you see in India, how many mutual funds are there, correct? People get confused because there are so many options of investing, and that's where the problem comes. When you have too many options and only 1 or 2 options are right for you, the chances of a lot of people failing is very high, and that's what's happening in the stock market and financial market, because see the number of funds in the market, correct? See the number of, so all these funds are marketing and this thing, and people get confused, correct? Every day in economic times, some new fund is recommended, and what happens is people try to chase every fund, and you can't do that, correct? You need to be selective and you need to focus, and that's a very big problem we see in the market. People trying to do investments by reading papers and reading and on their own, and even platforms like Zerodha, Paytm, people trying to create awareness, and a lot of people are going to do haphazard investments and not in a strategic, in a planned way. So it's a bad thing, but it's going to bring a lot of investors to the market, and a very good thing for us. Mature investments will come to us, mature clients will come to us, so we see a very good long-term future for our industry. Correct? I'll skip this slide. I'm showing how many debt funds are there. Now, debt funds are going to be under pressure for some time in the short term to medium term, because as interest rates go up, bond prices go down, correct? So you need to invest. Now, what I want everyone to do is relook at the four things, correct? Post-COVID, look at your situation. What's your story? How you look at India, how you look at the world, and how you look at the population demographics. And if you see these four boxes and plan your strategy, your portfolio is going to do very well. So you need to have a theme-based investing. You need to have a theme-based investing, and that is going to help you a lot. Yeah. So keep building your portfolio. I'm very optimistic. Now, how do you build your portfolio? So I'm going to share that slide down the line. Your strategy is to build a portfolio, correct? Going forward, the future is very bright, but that doesn't mean that you are going to make money unless you have a proper strategy. So let me go one slide. Sorry. Let me go one by one here. So first strategy you should be having: accumulate capital up to 2 crores at one place. Everyone, that's the phase. Like how we go for education, we go to primary school, then middle school, then high school, then go to college. So wealth building also is the same way process. Primary school. Primary school is accumulate wealth of 2 crores financial assets at one place, and that's called accumulation phase. The key to this process is follow a disciplined savings and investment process. You don't do random investments. You follow a process. Month after month you invest. Don't try to time the market. Follow up by using SIPs and invest only in 6-7 items. Don't invest in everything. You can't get everything in life. You need to make choices, correct? And what choices you make in life defines your life. Same thing in investments. Have limited choices and focus on that, and build your portfolio. That's accumulation phase. Then you create a wealth building phase, 2 to 5 crores. Once you cross, what I've seen, the first 2 crores of wealth building suppose if it takes 10 years to build that, from 2 to 5, it takes not 10 years, then you go achieve that in 3-4 years. So wealth building phase. So if this phase takes you 10 years, this will take you 4 years. That I've seen. And then the next phase, estate building. If this has taken you 4 years, this will take even less times, 3 years. So that's what happens. So these are the 3 phases where most of us are there. And this is called, the key driver is follow a discipline and savings process. So up to 10 to 30 crores of wealth you have. See, imagine the kind of independence and security it gives. It's not the power, the way you feel secure and when you build that kind of a wealth. And this is a process driven. It's like doing exercise every day in the morning, right from the young age, eating healthy food, correct? That keeps you in physical shape. Same way, investing systematically and not chasing returns, not to time the market, not jumping from one place to another place, just focusing and building the wealth. This is the key, correct? Once you achieve this 3 phase, some people will go to the 4th phase. They'll have financial assets. Then you diversify globally. That is 30 crores and above wealth. And that's called global estate, correct? Then there is a legacy estate, those who go beyond 150 crores or 200 crores. And this is the final, correct? The family wealthy office. Now, we don't have any clients here, but we have clients in all these phases. And so every phase, there is a different strategy. So up to 30 crores, you have to have a disciplined process. But most of the people, we keep on telling, they say yes, they listen to our talk, they listen to advice, they come and tell us, but again they after go home, oh, we'll wait, market is going to come down. They try to time the market and they miss it. Many people missed it last year, and then they do small investment, and then when market goes up, then they say, oh, I missed it. Don't do that. Follow a process. What you have agreed, stick to that process. Don't keep on changing. If you keep doing that, is a problem. So people like to deal with money, handle money, play with the money. The more you try to do that, money is like a soap. The more you handle your money, the less you'll have it. The more you are detached with money and you let the process work, the more money you'll make. That I have seen a pattern with all my clients. I'm in this business for the last 40 years, and whether you are India, America, anywhere, the more the person likes to deal with his money and the more he's attached to it, the less return he gets. So one of the key things I come to know, how many times the client is logging in his investment account. If he's logging every day and seeing his portfolio, he's going to get less return, 2 or 3%, than the person who looks at his account only once a month. He's a mature investor. So he focuses on job and looks at his account only once a month. And there are some clients who look at the account only once in 6 months. They follow the process. They don't care where the market is going and build. So the less you deal with money, the more money you'll have. So this is the lesson I have learned. And with that, I'll start taking questions. The future is very bright. And next 3 to 5 years are very good for India. So let me give you an example. 1980 to 1990, the BSE Sensex was 100. In 1990, it was 900. So in 10 years, it went up by 900%. 900% in those 10 years, correct? Indian stock market in last 2010 till today. So when Modi got elected, index was 24,000. Today it is 50,000. So in last 7 years, it has gone up only once. Doubled. It has doubled up only once, correct? Now, imagine if it doubles. India is still a poor country. India is still at the lower end, correct? It's not developed economy like America. So we have huge population and tremendous place to grow, correct? So if India grows like what it grew from 1980 to 1990, it went up 9 times in 10 years. Imagine it going up 9 times in next 20 years, where the index will be 9 times from current level in next 20 years. Imagine where the index will be. So index can go to any level. Stay invested, focus, correct? Don't try to shuffle your portfolio, try to make money every day, time the market, enjoy life, define a process and stick to it. And that is those people will make more money than anyone who's trying to dabble with the money. With that, I end my today's presentation and open the session for question and answers. I hope you enjoyed it. So my key theme today is that, as I said, the Indian economy is going to do very well, and stay invested, select 6 sectors and stick to it and build your portfolio. And like if you're playing a football match, like you have 11 players, you have some forward, some middle, and some defense, correct? Same way in your portfolio, you have some forward, middle order, and defense. Don't have everything forward because markets are going up. Everything in small cap, you'll get killed. You'll lose the match because the opposition will come and score the goal easily, correct? So you need to have defense. So you need to have pharma, you need to have technology, you need to have global investments, and forward is what? Infrastructure, banking. Those are forwards, and player strategy, correct? That's the most important thing. And if you like today's webinar, please subscribe to our channel by clicking here on this bell icon on your screen, and we'll appreciate it. And I will do this webinar once a month going forward and try to bring you some new topics. Okay, today's question is, first question, as educational intention, what are the effects of money printing, positives and negative? So the money is getting, so a lot of money got printed, yes, and in last 2 years, but it was good. If money wasn't printed, the whole world economy would have collapsed, correct? So the printing of money was good last time. Now the printing of money will slow down, and that's why interest rates will go up gradually. That's going to be happening, and because there is so much liquidity worldwide, so much cash floating, markets, cash always goes to the most efficient way of wealth creation. It will always go there, and that most efficient wealth way of creation is the stock market today. Those are the real assets. So money is going to chase that. That is the impact it's going to happen. Now, if you keep that money, if there is so much money in the world, and if you keep that money in a bank deposit, and inflation is going to be there, so because of so much printing, then your value of your money is going to go down if you keep it. So if inflation is 10% and a bank deposit is giving you 7%, so your real return is minus 3%. But if inflation is 10%, stock market goes up 15-17%, and you are getting 7% real return. But if you keep that same money in a stock bank deposit, you are getting 7%, and the inflation is 10, so you are getting negative 3%. So you need to generate a real return of 5% above the inflation rate, and that is the strategy you should have. Don't try to get the highest return. See, I tell people that simplicity is not in the business to get you. We never promote. We never advertise. Oh, we give 40%, 70%, 90% return to a client. We never attract business that way. That's the wrong way of doing it. Showing past returns. Of course, we gave very good returns last year. But if I promote that, we gave last year our portfolios went up by 100%, so next year is going to go. That's the wrong way. It's not possible to get 100% returns every year. What your strategy is to be to get just 4 or 5% returns higher than the inflation rate, and be happy with it. Be content. You can't be the fastest runner every time. 100 meters you run at the fastest pace, correct? But you can't run a marathon at the speed at what you run the 100 meters, correct? So same way, life is a marathon. You need to get a steady pace of return, which is 4 to 5%, and be happy with it. Don't change. So what we have also noticed in patterns with us here, that when clients get 20, 25, 30% return, 40, then they come, in that PMS we are getting 35. Should I do this? That I'm getting 40. Please don't do that. So then life, after I get married, someone comes and says, you want to see this is a better person than what you get to marry. No, I'll be miserably bad, correct? So stick to your choices, work with your choices. Don't keep on changing. And that's the other I find fallacy. Clients got very good return, then they want even higher return. No, stick to 4 to 5%. I bring down the client's expectation. Try to work out a strategy where you get 4 to 5% return, then the inflation rate, and be happy with it. Be happy with it, and the more you are reasonable in your return expectations, you'll do well, and that's what going to happen going forward. The next question is: so is it true to rather invest lump sum, not in mutual fund stock at this time, rather than SIP? No, you need to have a combination of both. See, SIP is always a very good thing, or best way of investing, and top up your investments when you have additional savings. And so I have clients who have built huge portfolio with me, and they started with 2 or 3 lakhs of SIPs, 50,000 SIPs. So I have clients who started with 50,000 SIPs, have in 2013-14, today have 1 crore portfolio. Clients, and in between they lump sum, they do that. Clients who started in 2013-14 by 2-3 lakhs SIPs have 5 to 7 crores portfolio. I have clients who have built more than 10-15 crores portfolio with me, 15, and they are all middle class families, but they followed, correct? They did a combination of both SIPs and lump sum, and that's the best way of investing. Any more questions? I don't see any more. Feel free to ask, correct? I see very good times ahead for Indian economy. So last decade, the US outperformed India. Going forward, I expect India to outperform the US. Now, what I do is, when you see India outperforming US, doesn't mean that you invest 100% money in India. You always need to have a rational balance. You need to have 25% a global portfolio. You need to have 25% money outside India, because Indian economy is only 3% of the world economy. So there are other growth areas in the world. So you should be in that and build a portfolio. With this, I end my today's session, and thank you for participating, and have a nice weekend, and look forward to talking to each of you individually. Thanks. Have a nice day. Bye.